Hello and welcome to Market Briefing. I'm Martin Bakkerdax, the European business editor here at the IB Times UK. Well, we're looking at a third consecutive day of advances for the major European equity indices. That is being led by about an 0.8% gain for the FTSE 100, and we're seeing broadly the similar percentage gains around the bourses. Investors are shrugging off a weak data set that saw out of Asia earlier today, particularly in China, where HSBC measured the Purchasing Managers Index of activity in the world's second largest economy for April at 50.5. Now that's slower than the 51.5 measurement from the month of March, and does suggest that the 7.7% GDP print that we saw for the first quarter there is likely going to be continued into, at the very least, the second quarter of this year. But what is driving equity sentiment seems to be three separate things. Firstly, the better than expected earnings season in the United States. And let's face it, that always seems to be the case. But also the fact that the European Central Bank might be prepared to lower its key refinancing rate either at its meeting next week or in the month of June. The reason they're going to do that, at least from the perspective of some investors, is because of the weak reading that we saw today for Purchasing Managers Index activity in the month of April. There was no great change across the European composite measurement. It was 46.5, and that's kind of what analysts were looking for. But in Germany, the figure dipped below 50. Now, that's the measurement that marks the difference between expansion and contraction for the first time since November of last year. And it does suggest that the Eurozone's ills are finally drifting to the core of the single currency area. Investors are also emboldened by the fact that we saw the re-election earlier this week of the Italian president, Giorgio Napolitano, and they're assuming that he will be able to put together a coalition government, end 2 months of political gridlock, and put forward the structural reforms that are desperately necessary in the third largest economy in Europe. As a result, fixed income investors at the very least have marked down 10-year Italian bond yields below 4% for the first time in about 2.5 years. And that's an excellent representation of risk appetite for an economy that previously was borrowing at the 10-year space nearer to 7%. So an extraordinary achievement, not only from the political perspective, but also as well from that massive bazooka that has been promised from the European Central Bank. Now, here in the United Kingdom, we had some interesting figures from a borrowing perspective as well. The public sector net borrowing figures released by the Office for National Statistics show that the government deficit for the full year of 2011-2012, which ended in March, beg your pardon, well, for the 12 to 13 fiscal year that ended in March, I should say, showed a very modest narrowing of the budget deficit to about 120.6 billion sterling. Now, the overall debt figure rose to about 75.4% of GDP. Now, that's an historic high, but nonetheless, Chancellor George Osborne will have to be soothed at least a little bit by the fact that his austerity measures do seem to be working, if slowly. On the toughest measurement, the budget deficit figure is about 7.6% of GDP. Now, you'll recall when the coalition government came to power in 2010, that figure stood at 11%. So that's an enormous achievement, but of course, many are going to argue that it's come at an enormous cost because we've had very little, if any, growth since then. In point of fact, let's be honest, we haven't had a sniff of economic growth since 2010. So ultimately, the test now remains in the next 2 to 3 years of the coalition's lifespan as to whether they can continue trimming the budget deficit whilst also engendering growth in the British economy. That remains to be seen. Many investors are skeptical, certainly are in the marketplace where sterling is falling against the major European currency pairs, but we're not seeing a great deal of movement in UK government bonds, and that tends to be the acid test for this sort of thing. You can check out those stories and a lot more on our economy page, and we'll see you tomorrow.